China's economy is facing a new challenge: deflation. For the first time in over a year, consumer prices have fallen. This unexpected turn of events has sparked concerns about the country's economic health. In February 2025, China's Consumer Price Index, or CPI, dipped into negative territory, recording a 0.7% decline compared to the previous year. This drop follows a period of modest inflation, with the CPI at plus 0.5% just 1 month earlier in January. The shift from inflation to deflation might seem like a positive development at first glance. After all, lower prices sound good for consumers. However, falling prices can also signal a weakening economy. When consumers expect prices to fall further, they may delay purchases. This decrease in spending can create a vicious cycle, further suppressing demand and slowing down economic growth. The decline in China's CPI has taken many economists by surprise. Forecasts had predicted a small drop, but the actual figure was lower than anticipated. The decline was broad-based, with falling prices across various sectors, including food, consumer goods and services. This widespread deflation has intensified concerns about the overall health of the Chinese economy. Understanding the reasons behind China's deflation requires looking beyond the headline CPI figure. Several factors have contributed to this unexpected economic shift. One significant factor is the high base effect from the previous year, the 2024 Lunar New Year, which typically sees a surge in spending and prices, fell entirely in February that year. This year, the holiday began in late January, leading to a higher base for comparison. Seasonal adjustments also play a role in interpreting the CPI data. When adjusted for seasonal swings, China's CPI actually shows a slight increase of 0.1% year-on-year in February 2025. However, even with this adjustment, the underlying trend points toward weak price pressures in the Chinese economy. This underlying weakness stems from a combination of domestic and external factors. Domestically, China is grappling with weak consumer demand. The once booming property market is experiencing a downturn, and consumers are more cautious with their spending. This hesitancy is partly due to lingering uncertainties from the COVID-19 pandemic and concerns about future economic prospects. Externally, China faces challenges from ongoing trade disputes, particularly with the United States. These disputes have created uncertainty for businesses and impacted global trade flows, further contributing to deflationary pressures. The emergence of deflation presents a significant challenge for Chinese policymakers, who are already striving to achieve a delicate balance between economic growth and price stability. China has set an inflation target of around 2% for 2025, the lowest in over 2 decades. This target, down from 3% in previous years, reflects the government's growing concern about deflationary risks. However, achieving this target while simultaneously aiming for a GDP growth rate of around 5% presents a complex economic puzzle. To stimulate growth and combat deflationary pressures, the Chinese government has announced plans for fiscal stimulus. These plans include increased government spending on infrastructure projects and measures to boost domestic consumption. The goal is to inject money into the economy, encourage spending, and create jobs. However, the effectiveness of these measures remains to be seen, particularly given the ongoing challenges in the property market and the uncertain global economic outlook. The Chinese Central Bank, the People's Bank of China, also has a role to play in managing inflation and supporting growth. It can adjust interest rates and implement monetary policy tools to influence borrowing costs and stimulate economic activity. However, finding the right balance between supporting growth and preventing excessive inflation will be crucial. The road ahead for China's economy is uncertain. While the government has taken steps to address deflationary pressures, significant challenges remain. Weak domestic demand, particularly in the property sector, continues to weigh on economic growth. The ongoing trade dispute with the United States adds another layer of complexity and uncertainty. Experts are divided on the future trajectory of China's economy. Some economists believe that the government's stimulus measures will be sufficient to avert a prolonged period of deflation and put the economy back on track for modest growth. Others are more cautious, pointing to the deep-seated structural issues in the economy, such as high levels of debt and over-reliance on investment-driven growth. They argue that more aggressive and comprehensive reforms are needed to address these underlying problems and ensure long-term economic sustainability. The coming months will be crucial for China's economy. The effectiveness of the government's stimulus measures, the evolution of the property market, and the outcome of trade negotiations will all play a significant role in shaping the country's economic future. The world will be watching closely as China navigates these challenges and attempts to strike a delicate balance between growth and stability in a rapidly changing global landscape.